Closing bell has just sounded on Wall Street, and we're wrapping up a day where big themes in AI, autos, media, and personal finance all shared the spotlight. I'm Grant Mercer, and this is Storm Stock Solutions, here to keep some clarity through the chaos of today's market action. Let's start with the narrative that really crystallized into the close. AI is moving from sizzle to plumbing. According to new reporting from MarketWatch's Charlie Garcia, the real money in AI chips may increasingly be in the supporting cast. Companies that provide ultra-pure water and other critical infrastructure for semiconductor fabs and data centers. Ultra-pure water is scarce, but big tech's AI ambitions are anything but small. That story taps into a broader theme traders are watching. As the first wave of AI leaders mature, attention often shifts to the less glamorous but essential parts of the supply chain. Another big storyline today was Tesla. MarketWatch's William Gavin highlights that a number of analysts are starting to frame Tesla less as a pure EV play and more as a platform for autonomy and robotics. Even with EV sales under pressure across the industry, the bull case that's emerging is built around self-driving software, robotaxis, and even humanoid robots, not just car volume. For the market, that creates a tension. Near-term delivery and pricing headwinds on one side, long-term optionality on the other. That kind of split narrative can translate into volatility as investors debate what they're really paying for. In media and entertainment, we continue to see digestion of that massive, roughly $83 billion Netflix move for Warner Bros. Discovery, covered by Lucas Alpert at MarketWatch. Some analysts view it as an aggressive play to consolidate premium content. Others see it as a defensive reaction to the rising power of YouTube and TikTok with younger audiences. For the stock market, the key questions are about synergies, antitrust risk, and whether traditional long-form streaming can sustain growth in a world obsessed with short-form, ad-supported video. Stepping away from the tick-by-tick, much of the day's conversation tilted toward household balance sheets and intergenerational money, topics that, while not moving the indices today, do shape longer-term flows into and out of risk assets. Quentin Futrell had several widely read pieces at MarketWatch that tapped into this theme. One looked at a couple in their 50s with a paid-off $450,000 mortgage, rental income, and about $500,000 in IRAs, asking the simple but powerful question: where are we vulnerable? That's the mindset a lot of near retirees have right now, trying to stress test their plans against inflation, market swings, and health costs. When that group feels secure, they may be more willing to stay invested. When they feel exposed, you can see more caution and demand for income products. Another Futrell piece explored a parent trying to do right by everyone by giving a son $250,000 in cash and a daughter 50% of a co-owned rental property. Those kinds of estate and gifting decisions can quietly reshape real estate markets, local rental supply, and even small business funding, as younger generations either receive a lump sum or a stake in property. They're not intraday catalysts, but they're powerful background currents. He also detailed a family dispute over a late father's multi-million-dollar California real estate portfolio, where the widow says the properties are heavily mortgaged and is moving to sell. That raises questions about leverage, transparency, and generational expectations, and it echoes a broader issue. A lot of wealth in the U.S. is tied up in real estate with varying levels of debt. As those portfolios change hands, decisions to delever or liquidate can influence regional property prices and, indirectly, bank exposure. On the retirement front, Alessandra Melito at MarketWatch profiled a 65-year-old who has diligently maxed out retirement contributions, built up about $1.6 million, and is now asking, "When can I slow down?" That captures another market-relevant idea. As more boomers hit their retirement targets, their shift from accumulation to decumulation can affect demand for stocks versus bonds, annuities, and cash-like instruments. Looking ahead to tomorrow, there are a few key threads to keep on your radar. First, the AI infrastructure angle. Ultra-pure water, fab support, and data center inputs is likely to get more attention as analysts dig into who actually benefits from the next phase of AI build-out. Second, watch how Tesla and the EV complex trade as the market continues to weigh near-term delivery realities against that longer-term autonomy and robotics narrative. Third, expect more analysis around the Netflix, Warner Bros. Discovery tie-up, including regulatory scrutiny, and competitive responses from other media and tech giants. And in the background, those personal finance and estate stories are worth keeping as part of your framework. They're not trading signals, but they help explain the risk appetite, or risk aversion, of key investor cohorts that move these markets over months and years, not just days. We'll be back with a fresh pre-market setup before tomorrow's opening bell, walking through any new earnings, policy headlines, or macro data that could reset the tone. Remember, this is information and education, not personalized financial advice. As always, I'll be here to keep clarity through the chaos of these markets. On behalf of Storm Stock Solutions, I'm Grant Mercer. Stay sharp, stay steady.